Renting is throwing money away. You've heard that your whole life, from your parents, from your relatives at Thanksgiving dinner, from that coworker who bought a condo and hasn't stopped talking about it since. It's practically gospel, a cultural truth so deeply embedded that questioning it feels almost un-American. But what if it's wrong? Not just slightly wrong. What if the math behind one of the most repeated pieces of financial advice in history has been misleading an entire generation into the single largest financial decision of their lives without ever showing them the full picture? Today, we are going to do what almost nobody in real estate, personal finance, or mainstream media ever actually does. We're going to run the real numbers, not the cherry-picked version, not the version your real estate agent shows you, not the emotional version built around the dream of homeownership, the full, honest, uncomfortable math. And by the end of this video, you are going to see this decision, maybe the biggest financial decision of your life, with completely different eyes. Here's why this conversation is so hard to have honestly. Buying a home is not just a financial decision. It is one of the most emotionally loaded decisions a human being can make. It's wrapped up in identity, security, family, status, the American dream, and decades of cultural conditioning. Real estate agents have an obvious financial incentive to tell you to buy. Mortgage brokers have an obvious financial incentive to tell you to buy. Your parents, who watched property values rise for 40 years, have an emotional incentive to tell you to buy. And the media, real estate news, renovation shows, neighborhood market reports, an entire multi-billion-dollar media ecosystem built around the assumption that buying is the goal and everything else is just a stepping stone. Against all of that stands the renter, quietly writing a monthly check, being told they're building someone else's equity, feeling vaguely judged at dinner parties. But here's the thing, the renter might be winning, and they almost certainly don't know it. Not always. Not in every market, not for every person, but far more often than the conventional wisdom admits. So let's build the real picture from the ground up, starting with the foundational myth. Renting is throwing money away. Let's actually examine this claim, because it doesn't survive contact with basic logic. When you rent a home, you pay money for a place to live. In return, you get shelter, maintenance, flexibility, and zero exposure to market risk. You receive a service. You pay for it. That's a transaction, not a waste. By the same logic, buying food is throwing money away. You paid for something and consumed it. Going to the dentist is throwing money away. Paying for car insurance every month, you don't crash. Throwing money away. The framing only works because housing has been culturally coded as something you're supposed to own. When you rent, you're using an asset that someone else owns, and that feels wrong somehow, like you're losing a game. But here's the math reality. When you buy a home, especially in the early years of a mortgage, the vast majority of your monthly payment is not building equity, it's paying interest. On a standard 30-year mortgage at 7%, in month one of your loan, roughly 70 to 80% of your payment goes directly to the bank as interest. Not equity, not investment. Gone. So the homeowner paying $3,000 a month? In the early years, roughly $2,100 of that is going to the bank as pure interest cost every single month. And they're calling the renter the one who's throwing money away. That's not the whole picture, obviously. The home may appreciate. You are building some equity. There are real benefits to ownership. But the renting is waste, buying is investment. Framing is built on a deeply selective reading of the numbers. Now let's look at what the complete picture actually includes, because most homebuyers are shown a dangerously incomplete version of the cost of ownership. When someone tells you they bought a house for $400,000, here's what they almost never factor into the true cost of that purchase. Let's walk through it systematically. A 20% down payment on a $400,000 home is $80,000. Most financial conversations treat that $80,000 as simply gone. It's now equity, which feels like a safe transformation. But that $80,000 had an alternative, invested in a diversified index fund at the historical average return of roughly 8% annually. That $80,000 becomes approximately $372,000 in 20 years. That's the opportunity cost, not a cash loss, but a very real economic cost that almost nobody accounts for when they're running the buy versus rent numbers. Buying a home typically costs 2 to 5% of the purchase price in closing costs alone. On a $400,000 home, that's $8,000 to $20,000. Paid up front, producing zero return, gone on day one. Selling a home? Another 5 to 6% in agent commissions and fees. On a $400,000 sale, that's $20,000 to $24,000, eliminated instantly. Added together, buying and then selling a home can cost $30,000 to $45,000 before you account for a single mortgage payment. Then there are property taxes. Depending on where you live, property taxes run 0.5% to 2.5% of your home's assessed value annually. On a $400,000 home, that's $2,000 to $10,000 per year. Every year, forever, regardless of whether your home appreciates. Then, insurance and HOA fees. Homeowners insurance, PMI, if your down payment was under 20%, and HOA fees in many communities add another $200 to $800 per month to the true cost of ownership. And then maintenance and repairs. This one is chronically underestimated. The widely used rule of thumb is 1% of home value per year in maintenance costs, though many financial planners suggest budgeting closer to 1.5% to 2%. On a $400,000 home, that's $4,000 to $8,000 per year. Every year, the roof doesn't care about your vacation budget. The HVAC system doesn't check your savings balance before it breaks. And this isn't optional spending. It's the cost of not having your asset deteriorate. Now let's do the full number. Monthly mortgage payment on a $400,000 home at 7% with 20% down on a 30-year fixed mortgage. Approximately $2,130 in principal and interest. Add property taxes assuming 1.2% annually, $400 per month. Add insurance, $150 per month. Add maintenance reserve at 1.5% annually, $500 per month. True monthly cost of ownership before any repairs, before any unexpected expenses, roughly $3,180 per month. Now compare that to what the same $400,000 home rents for in your market. In many markets, the rent for an equivalent property is meaningfully lower than the true cost of ownership. And the renter? They keep their $80,000. And they can invest it. Here's the counterintuitive truth that the entire homeownership is always better narrative tries to bury. If a renter invests the difference between their rent and the true cost of buying every month consistently, they can end up wealthier than the homeowner. Even accounting for home appreciation, this is not fringe math. This is what comes out of honest spreadsheets run by financial economists. The New York Times even built a rent versus buy calculator around this exact concept. And in many American cities today, renting and investing the difference mathematically outperforms buying. The key words are, invests the difference. We'll come back to why most people don't, and why that's a psychology problem, not a math problem. So if the numbers are genuinely ambiguous, if renting can be the better financial move in many markets and many circumstances, why does practically everyone still frame buying as the obvious, responsible adult decision? Because this isn't primarily a math decision, it is a psychology decision. And there are several powerful psychological forces pushing you toward ownership regardless of what a spreadsheet says. Force number 1, loss aversion and the pain of paying rent. We talked about loss aversion in a previous video, the psychological finding that losses feel roughly twice as painful as equivalent gains feel good. Paying rent triggers the feeling of loss. Every month, money leaves and doesn't come back. There's no artifact, no document, no asset to show for it. It feels like loss, even when financially you may be ahead. A mortgage payment, by contrast, comes with a statement that shows your equity inching upward. Even when most of that payment is interest, even when you're net negative on the investment after accounting for all costs. The feeling is one of building, accumulating, progressing. This is why the throwing money away framing is so powerful. It weaponizes loss aversion. It makes renting feel emotionally like financial failure, regardless of what the numbers actually say. Wealthy, financially sophisticated people know how to separate the feeling of a financial decision from its actual economics. Most people never make that separation. And the entire real estate industry profits from that gap. Force number 2, the endowment effect and homeownership identity. There's a fascinating psychological phenomenon called the endowment effect, first documented by behavioral economists Richard Thaler and Daniel Kahneman. The finding is this: people place significantly higher value on things they own versus identical things they don't own. In classic experiments, people given a coffee mug would demand twice as much to sell it as others were willing to pay to buy the same mug. Ownership creates attachment, and attachment inflates perceived value. This plays directly into the home ownership psychology. Once you own a home, it becomes part of your identity. It becomes your home. You make decisions about it differently. You evaluate it differently. You defend it emotionally, which means you are almost certainly not an objective evaluator of whether your home was a good financial decision. Nobody is. The endowment effect guarantees that you'll see your property through the lens of attachment rather than pure economic analysis. This isn't a moral failure. It's a universal human quirk. But it means you should be skeptical of the financial advice of people who already own homes and are enthusiastically encouraging you to do the same. Their endorsement is not purely rational. It is emotionally influenced by their own ownership identity. Force number 3, social proof and cultural momentum. Home ownership rates in the United States hover around 65%, which means roughly 2/3 of adults own their home. When something is that common, it becomes a social norm. And social norms are extraordinarily powerful psychological forces. We are tribal creatures. We default to the behavior of the majority around us as a signal of what's correct, safe, and appropriate. Everyone buys a home. So buying a home must be the right move. So renting must be the wrong move. Psychologists call this normative social influence, changing your behavior not because you've evaluated it rationally, but because you don't want to deviate from the group. The financial services industry, the real estate industry, and American cultural mythology have collectively made homeownership a social norm powerful enough to override independent financial analysis. And the people who opt out, they face quiet social judgment. The renter who has chosen to rent deliberately for financial reasons often has to justify themselves in conversations where homeowners never have to justify their choice at all. The default is buy, and anything that deviates from the default requires explanation. That social asymmetry is not a reflection of financial reality. It is a reflection of cultural conditioning, and recognizing it is the first step to making this decision with your brain instead of your tribal instincts. Now, having said all of that, buying a home is absolutely the right financial decision for many people in many circumstances. This is not a pro-renting manifesto. This is a pro-thinking clearly manifesto. So let's talk about when buying genuinely wins, and what variables actually drive this decision. Variable number 1, time horizon. This is the single most important factor, and it's also the one most people dramatically underestimate. Buying a home is expensive to enter and expensive to exit. Between buying costs, selling costs, and the interest-heavy early years of a mortgage, you need significant time in a home before the math tips in ownership's favor. Most financial models suggest that in a typical market, you need to stay in a home for at least 5 to 7 years before buying starts to outperform renting when you account for all costs. In expensive, slow-appreciating markets, that number can stretch to 10 years or more. The average American moves every 5 to 7 years, which means a huge portion of home buyers are selling before they've hit the break-even point, absorbing all the costs of buying without capturing the compounding appreciation that makes ownership valuable. Before you buy, ask yourself with brutal honesty, am I actually going to stay here for at least 7 years? If the answer is anything less than very confident, yes, the financial case for renting is almost certainly stronger. Variable number 2, the price-to-rent ratio. This is a metric that financial economists use, but almost no first-time buyers have ever heard of. And it's arguably the most important number in the entire rent versus buy analysis. The price-to-rent ratio compares the purchase price of a home to its annual rental cost. Take the home's purchase price and divide it by the annual rent for an equivalent property. A ratio below 15 generally favors buying. Between 15 and 20 is a gray zone. Above 20, renting is usually the stronger financial choice. In many major American cities today, San Francisco, New York, Los Angeles, Seattle, Miami, price-to-rent ratios are 30, 40, even 50. These are markets where the math of renting and investing the difference is clearly, unambiguously superior for most buyers. In smaller Midwestern and Southern cities, Cleveland, Memphis, Indianapolis, Birmingham, ratios are often in the 10 to 14 range. These are markets where buying has a genuine financial edge. Geography matters enormously. And yet the conversation is almost always had as if it's a universal truth, rather than a deeply local calculation. Variable number 3, what you would actually do with the difference. This is the honest reckoning that most rent versus buy analyses skip over. The math that shows renting can win assumes that the renter takes the difference, the down payment, the monthly cost differential, and invests it consistently across decades without touching it. And here's the uncomfortable truth. Most people won't. This is where buying a home, despite its mathematical inefficiencies, has a real behavioral advantage. A mortgage is a forced savings mechanism. Every month, automatically, without requiring discipline or decision-making, you are building equity. The bank forces you to make the investment, whether you feel like it or not. Left to their own devices, coordinated with the money sitting in a checking account rather than locked into a mortgage, most people spend it. Lifestyle inflation, small luxuries that compound into large drains, the hedonic treadmill doing what it always does. This is not a character flaw. It's human psychology, and it means the theoretical financial superiority of renting and investing often doesn't materialize in practice because the investing part doesn't happen. So here is the honest framework for this decision. If you are a disciplined investor who will genuinely invest the difference, and you're in a high-ratio market, renting is likely the smarter financial move. If you are honest that you lack that discipline, that the money won't get invested if it's not locked away, buying a home may be the better behavioral decision, even if it's the less optimal mathematical one. If you plan to move within 5 to 7 years, renting is almost certainly better. If you have strong roots, a long time horizon, and you're in a low price-to-rent ratio market, buying makes compelling financial sense. Before making any decision, look up the price-to-rent ratio in your specific city, not the national average, your city, your neighborhood. This one number tells you more about the rent versus buy math in your market than any amount of conventional wisdom ever will. Run the full cost of ownership, not just the mortgage payment. Include property taxes, insurance, maintenance reserve, and the opportunity cost of your down payment. Then compare it honestly to what you'd pay in rent for an equivalent home. The gap, and what you would realistically do with it, is the real number that matters. Here's what we've actually established today. Renting is throwing money away is not a financial truth. It is a cultural belief, a powerful one, emotionally resonant, socially enforced, and financially incomplete. The real math on home ownership, when you include closing costs, property taxes, insurance, maintenance, and the opportunity cost of your down payment, is far less flattering than the simple build equity every month narrative suggests. In high price-to-rent markets, renting and investing the difference can demonstrably outperform buying. This is not fringe opinion. It is what honest financial analysis shows. And the psychological forces pushing you toward buying, loss aversion around rent payments, the endowment effect, social proof, cultural identity, are powerful precisely because they operate below the level of conscious analysis. You feel like you should buy before you've run a single number. But here's the part I want to leave you with. This is not an argument that renting is always better. It's not a case against homeownership. For many people, in the right market, with the right time horizon, with genuine roots and honest self-knowledge about their investment discipline, buying a home is a wonderful financial and life decision. The goal was never to change your answer. The goal was to make sure you're asking the right questions, because the biggest financial decisions in your life deserve more than inherited assumptions and dinner table wisdom. They deserve your full, clear, unbiased attention. The person who buys because they ran the numbers and buying wins, that's a great decision. The person who buys because that's just what you do when you're an adult, that's a gamble disguised as wisdom. And the renter who invests the difference, watches their portfolio grow, and lives with total flexibility to move when opportunity calls, they might be the smartest person in the room, even if nobody at Thanksgiving dinner will ever believe it. Know your numbers, know your market, know yourself, and make this decision with your head, not with a feeling that someone else put there. If this changed how you think about one of the biggest financial decisions of your life, drop a comment. Are you a renter who feels vindicated? A homeowner who's rethinking the math? Someone on the fence who needed to hear this? I read every comment. And if you want to keep building the financial intelligence to make decisions like this clearly, calmly, and without the noise, subscribe. New video every week. Because at Money Psychology, we don't just talk about what to do with your money, we talk about how to think about it. See you next time.